How to start a business in 2020, from business idea and plan to marketing and scaling, including funding strategies, LLC and legal structure and administration tips. Written by John Smith. Narrated by Mike Wayne and James Miles.
Introduction. Investors should expect higher private equity returns from non-liquidity and long-term commitments than public equity investments. Unlike the public equity, private equity investments initially show negative returns for a relatively long period and have accrued negative net cash flows that investors will take into account when developing a new plan or approving new investments. Due to the characteristics of the return and cash flow profile, this trend is known as J-curve, reflecting the private equity fund's propensity to provide negative returns and cash flows in early years, and investment gains and positive cash flows later in life, as the portfolio companies grow and eventually exit their portfolio. Fund portfolios have a similar J-curve trend, but the J-curve effect is typically more pronounced because it takes longer to announce a positive internal return rate, IRR, when capital calls are made on funds for a longer term. In January 1982, William Simon, former U.S. Treasury Secretary, and a group of investors purchased $80 million of Gibson Greetings, a manufacturer of greeting cards, rumored to have been received by the investors at just $1 million. In mid-1983, just 17 months after the original deal, Gibson made the IPO for $290 million, and Simon made around $66 million. The success of the investment from Gibson Greetings drew wider media attention to the growing boom in leveraged shopping and launched the private equity age as an asset class. Most investors do not directly invest in private enterprises without the skills and resources required for structuring and tracking investments. Alternatively, investors are indirectly investing via a private equity fund. Some institutional investors have the magnitude needed to develop a varied private equity fund portfolio themselves. In contrast, others have to invest via a fund to allow a more diversified portfolio than one investor can create. Since its emergence in the early 1980s, private equity has grown to include a wide range of approaches, including risk capital, immovables, assets, and many other illiquid instruments. The variety of investors able to access private equity has also increased. In the 1980s, the major private equity investors were insurers. In recent times, public pension funds and colleges and other funds have become major capital sources. Today, higher net worth individuals and families can access this special and desirable asset class by feeder vehicles. In economics, the J-curve, under a certain set of assumptions, is the time course for a country's trade balance, following a devaluation or weakening of its currency. Devaluated currency means that imports are more costly and, on the presupposition that import and export amounts do not change much at first, this leads to a reduction in the current account, larger deficit or less. Nevertheless, export volumes may start to rise sometime later, as their prices for foreign buyers are lower and hence more affordable, and domestic consumers may buy less expensive imports. Finally, if this occurs, the trade balance should go to a smaller deficit or greater surplus than before the devaluation. Similarly, if a currency revaluation or appreciation happens, the same logic may be used and contributes to an inverted J-curve. The total value of imports will rise immediately after the weakening or devaluation of the currency. Exports remain greatly unchanged, due in part to pre-existing trade contracts to be honored. Since import prices are rising short-term because the depreciation is responsible, and also there is a pause in the short term in changing import demands, there is an immediate jump that is accompanied by a delay until the long term prevails, and customers stop importing as many expensive goods. In the short term, the market for the more costly imports, and for products that are cheaper for foreign currency buyers, remain inelastic. That's because the consumer's appetite for appropriate, cheaper, which may not exist.
Sample complete. Ready to continue?